I don't know where we stand in terms of the residential housing cycle, and it has different behavior characteristics simply because people live in the houses in great many cases. Prices increasing at far, far greater rates than construction costs or inflationary factors. Sometimes there can be some pretty serious consequences. Home construction comes about through savings. Now, there's no question that terms have become easier and easier. People think about lending in general. Generally, the more the asset class becomes inflated, the less a prudent banker will lend. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll probably be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably to get any big mispricing across the board. If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's and again take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now. Well, if there's a strong decline in the housing market, my guess is that whatever we lose in carpet we'll be making up for somewhere else, because it would, a lot of the psychological well-being as well as the financial well-being of the American people is tied up with the fact, or comes from the fact, that they feel so good about what has happened with their home ownership over the years. I don't know where we stand in terms of the residential housing cycle, and it has different behavior characteristics simply because people live in the houses in great many cases. So will not behave necessarily the same as other markets. But when you get prices increasing at far, far greater rates than construction costs or inflationary factors, sometimes there can be some pretty serious consequences. Housing, everything real estate related, was part of a bubble, and it was a huge bubble. And because homes are such an important part of the resources of most families, I mean, you have 75 million or so single-family homes, and for a great many of those 75 million people, it's their most important asset. So when that bubble burst, because of really overproduction of new homes, it affected millions of people, including real estate brokers. It posed a couple of very tough years to come, and there wasn't any way around it. I mean, if you had too many houses, you had to wait till household formation started sopping up that inventory, and that's basically occurred now. Anytime a home is constructed, it represents somebody's savings. I mean, the home buyer may buy it for nothing down, but that means he's borrowing 100% of the mortgage through a mortgage that somebody else has saved somewhere, maybe intermediated 3 or 4 times or something of the sort. But home construction comes about through savings. Now, there's no question that terms have become easier and easier, and I've talked to certain mortgage bankers about this subject, but terms have become easier and easier as prices have increased. Now, that is absolutely counter to, how people think about lending in general. Generally, the more the asset class becomes inflated, the less a prudent banker will lend. But of course, in this country now, you have mortgages intermediated in a way that the person buying the mortgage, in the case of, I'm thinking of Freddie and Fannie and other forms like that. So we're about the lower priced houses, but the mortgage buyer does not need to care about what kind of mortgage, what kind of a financial transaction the purchase is. All they have to do is look at the guarantee, and they look at that rather than whether somebody's put any money down or anything of the sort. So I think you've had easy financing facilitating a boom in real estate prices, even at the higher levels. Yeah, C corps really it doesn't make any sense. I mean, I know there are C corps around that are in real estate, but there are other structures that are more attractive. There really aren't other structures. I mean, Lloyd's is an attempt at it to some degree, but there aren't other structures that work well for big insurance companies. I mean, you can't have a Walmart very well that does not exist in a C corp. So they are not subject to S corp or partnership competition that determines the returns on capital in the discount store field. But the disadvantage of our structure, combined with the competitive nature of people with better structures buying those kinds of assets, will ever lead to anything really interesting. Although I would say that we missed the boat to some extent during the RTC days. I mean, it was a sufficiently inefficient market at that time, and there was a lack of financing that we could have made a lot of money if we had been geared up for it at that time. We actually had a few transactions that were pretty interesting, but nothing that was significant in relation to our total capital. If I had a way of buying a couple 100,000 single-family homes and had a way of managing. The management is enormous. It was really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar, because you can take a 30-year mortgage. And if it turns out your interest rate's too high next week, you refinance lower. And if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.